That pretty much sums up my feelings right now. I was looking for a good picture of somebody hiding under a bed, but I think we can all relax a little bit at least. I said last summer that I thought we'd seen a bottom in June. That's still the bottom, knock on wood, and I think it will be. I didn't have any expectations of a big bounce with what we'd been through in the last 3 years, and concerns over things like QE being tapered, all that sort of stuff. Simply the fact that most of the companies, after 3 years of bear markets, thankfully not the ones presenting here, but most of the companies in the space are broke. And there's no getting around the fact that in order to really have any kind of big whoosh, short of the gold price going to $5,000 overnight, which would be a bad thing because that only really happens for the wrong reasons, so I don't want to see that. It takes time for these companies to basically rebuild their stories, re-attract an audience, and recapitalize themselves. So this is definitely going to be a rich getting richer market for a little while. It's going to be the bigger guys actually pulling the freight, and it's not going to be a rising tide lifting all boats sort of market for, I would think, at least several months minimum. Basically, traders that I've talked to, and I know a few large active traders, they're pretty skeptical still, which is actually, I'm okay with that. I'd actually be a lot more nervous if everybody was just crazy optimistic and, getting out the pom-poms and rah-rah, everything's going to be great. If I've got any concern short-term about, potential black swans, I'd have to say I'm a little bit nervous still about New York. And it's not because I see anything terrible in New York, but because when I look at that market, it is everybody out with pom-poms, and you just don't see anybody in that market who isn't basically 100% optimistic. Nothing phases those guys these days, which I always get a little paranoid when I see everybody that happy, because that doesn't generally end well. One thing I want to comment on here, I went through this a couple of issues ago, but I know only some of you are subscribers, some are subscribers to other guys. A big issue in the gold market, this was really weighing on gold until it started, and that was the taper. QE ends, we don't have the Fed printing all this paper. They still actually are printing paper. It's actually going to be a year before they get to the point where they're not adding to their balance sheet, even if they keep tapering every month. But there was this concern that without that, we're not going to see this huge monetary expansion that's going to make the gold price go up. This is a very interesting chart that I found a little while back. This is basically the size of the Fed balance sheet. The size of the Fed balance sheet is essentially a proxy for how much QE they've done. When they do QE transactions, they're enlarging their balance sheet. On top of that is a trace of the Spider Gold ETF. You'll notice something interesting. During QE1 and QE2, which is basically this climb, and then this climb is QE2, there was some correlation, a decent one. It's not actually a great correlation if you look at that period. If you look at QE3, which is what everybody's worried about, the correlation between QE3 growth in the Fed balance sheet and the gold price is negative. I repeat, the correlation is negative. As the Fed expanded its balance sheet, the gold price went down. There's a lot of reasons for that, but the important thing to note here is if you're worried about the gold price because you're worried about the taper, I think you can stop worrying, because that was not the reason why the gold price did what it did in the last year and a half. I've got no particular reason to think their tapering is going to have any big impact. I don't have time today to go into it. I went in, that editorial is floating around on various websites, including mine, but I walked through what the QE transactions actually are and the reasons why we didn't actually see much monetary expansion. Yes, the Fed's balance sheet expanded, but the monetary base didn't. What makes the monetary base M2 that counts in the real world grow is actually lending. Banks grow the money supply by lending. There's been very little of that in the US in particular, because essentially people were not optimistic at all, and there was very little new borrowing going on. If we're likely to see any inflation in the sense that all of us think about it, CPI inflation coming out of that, it's actually going to happen over the next 2 or 3 years. As people get more optimistic, they start borrowing, and the actual money supply that we all live with day to day starts expanding. I'm not one of these guys who's expecting hyperinflation or anything, but I'm actually more worried about deflation short term. But I think if there's going to be an inflationary move because of that expansion. It's actually something where there's a big time lag on it. So don't expect to see it for a year or two, and only if the economy is doing well. And from the looks of things, the US dollar, the TNX, that's the yield on the 30-year Treasury. They apparently didn't get the memo either, because with the Fed tapering, the US dollar was supposed to do this, and the bond yields were supposed to do this. The black line that I've drawn here, that's actually the date of the initial taper announcement. There's been 2 more since then, of course. Basically, the US dollar's done nothing. Part of the reason for that is when you look at currencies, you have to remember there's no such thing as a one currency trade. Currency trades are always pair trades. There's always a trade on the other side of that currency. You don't buy dollars and sell nothing. If you're buying dollars, you're selling gold, or you're selling euros, or you're selling yen. I think part of the reason why you're seeing this is there was, at about the same time, the yen started strengthening a little bit again after the Bank of Japan had spent 9 months pounding it and trying to get it down as far as they could. The other thing that's actually been quite a bit stronger since the middle of December has actually been the euro. The EU's not exactly doing fantastically, but it does look like it's come off its bottom, and it's seen a lot of buying in the euro because of that. I mean, arguably too much buying, probably more buying than the ECB's happy about, but nonetheless, that's part of the reason you're just not seeing this big move in the dollar. This was sort of interesting. I mean, it got to there. You would have expected to see a little more movement on this, and I am expecting to see those yields get to, say, 3.5%, 4% up here somewhere by the end of the year. But I'm not really that worried about it. I mean, if the economy in the U.S. does what I hope it does, which is almost 3%, we should have 3.5% or 4% bond yields. There's nothing scary about that. I'd be a little bit nervous if I owned $1.5 million condo in Vancouver, but or one of the things on the waterfront in Toronto. But let's not go there. I'm not going to talk real estate. You don't need much mortgage rate increase to make that stuff scary. But it's basically the interest rates increases I'm expecting are the ones you would normally get early in an economic cycle. There's nothing particularly scary about them. I'm not expecting them to go through the roof. I mean, it really hasn't done. It's actually come off slightly since that was announced. Part of this was, of course, people jumping into treasuries because they were worried about New York. When that turned around, you're starting to see them come up again a little bit, but only a little. So that's not looking very scary. Obviously, as I just said, part of the reason why you didn't see those moves was because of moves in and out of this. This is the S&P going back a couple of years. Frankly, I would have been a lot happier if I'd seen this get down to here somewhere. I think New York is due for a better correction at its head. 6 or 7% wasn't really enough to give me a lot of comfort. I would have much been happier to see 15%. I just think we're due for one, given how long and strong a run this has been. I just think the market would be healthier if it's got those corrections. It's impressive it's come out this much, but I start seeing things like $19 billion deals to pick up a no revenue messaging service, and stuff like that just feels way too 1999 to me. And 1999 was fun, but 2000 wasn't. So I'm kind of hoping everybody relaxes a little bit in New York and maybe gets a little bit less optimistic. Now on to the stuff that we care about a little more closely. Here's the gold price. I'm pretty happy with what it's done. I mean, the taper was announced here. There was a little bit of a knee jerk, and it's come up, put in a nice double bottom. I like the fact that it seems to have gotten quite easily through the 200-day moving average, and that seems to be a support rather than resistance now. I think all of us probably, this level and this level are the ones that we're really worried about. I'd really like to see it get through 1350. I think it might have to consolidate a little bit before it gets there, because it does look fairly overbought right now. So a bit of sideways is probably not a bad thing. I'm not a gold bug in the traditional sense, so I think the gold price goes up and down when more people want to buy it than want to sell it, and when more people want to sell it than want to buy it. Like, I don't think there's any agenda there. Do I think there's a bit of rigging in the market? Yeah, I think there's a bit of rigging in pretty much any market you can think of. And I think some guys are probably going to get their hands slapped in London before the year's over, because it's become fairly obvious there probably was some rigging in the AM and PM London fix, among other things. But I think what's happened here is really, not to sound stupidly oversimplified, we ran out of sellers, basically, which is usually how bear markets exhaust themselves. The buying's been quite strong in Asia. It's stayed stronger longer than anybody really expected it would. It'll come off a little bit in the next couple of months now that we're past New Year's in China, but it's still remained fairly strong, and probably one of the most hopefully telling things just in the last 2 weeks is U.S. ETF buyers have gone from sellers to being buyers. They basically haven't been net buyers for a year and a half. If we've got similar demand in China and we have net buying on the ETFs, my target for this year is 1,400, but I think we may get past that if we have both those things going at the same time, which I wasn't really counting on when I targeted 1,400. I was really just counting on Asian demand. Base metals are a little bit trickier. I mean, this is copper. I mean, I only threw up a copper chart here, but essentially, you know, they go with growth. Copper, we're expecting a small surplus this year, a larger one next year. That surplus may or may not come to pass because it is quite small in relation to the entire copper market. It wouldn't take much of a blip on any of a number of mines that are under development and construction to actually kill that surplus and make it go away. So, and zinc, you had one big mine come off stream last year. There's another big mine coming off stream late this year. By the time we get into 2015, zinc should definitely be in supply deficit. So I'm expecting copper to do okay, zinc to do a lot better. But one thing I will note is warehouse inventories in London and in Shanghai have been coming off quite steadily, especially in London, which is sort of the world's warehouse inventory, the metals inventory most people watch. In both of those places, those inventories have been coming off quite strongly now for 2 or 3 months. What I'm not entirely sure of is that going into another warehouse or is it getting consumed? And I think it's a little bit of both. So I'm not getting too raw about base metals just yet. I mean, I think next year is probably zinc's year. I'm expecting copper to be flat, maybe a little bit down, but I think there's potential for a pleasant surprise there because those inventories are coming off quite fast, a lot faster than I would have expected them to. And there's our favorite little market. That's not a pretty chart. There's no getting around it. The end of it looks a little bit more interesting though, and I'm just going to jump over to a one-year version. This looks a lot more encouraging. I mean, this is pretty much exactly what I was hoping to see, and it actually moved a little faster than I thought it would. I thought this was a bottom. I knew we needed to see another one, especially and this is sort of when the taper was announced, oh my God, we're all going to die. Went back to here, plus tons of tax loss selling. You normally get a bounce right after tax loss selling, but I'm more encouraged actually by the fact that it came back, held this level, and came back up through it nicely. The big question mark is probably the next month or so. Any of you that have traded these stocks for more than a year knows all about the PDAC curse. It's quite famous when it comes to the resource sector. The market tends to have a pullback after PDAC. The reason for that, I think, most years is simply that because it's the big confab, all these companies are trying to put news out. Anybody that's been saving up drill results, stuff like that, you see tons and tons and tons of news come out in the 2 weeks before PDAC. In a year like this, I'm not so sure we're going to see much of a pullback because there really wasn't that much news. The news flow was not that heavy. And that goes back to the original comments I made about the sector, where most of the companies basically are broke. They aren't doing anything. You've got a fairly small subset of companies that's actually active. Those companies, I think, can get a lot of attention in this market, but there hasn't been enough of a lift for everybody else that I'm really expecting to see any big drop-off after PDAC. You know, we'll find out in 2 weeks. I mean, one thing that's going to be big because of the confusion about how much, if any, has the U.S. economy slowed down, how much of that's weather. The next payroll number, which is next Friday in the U.S., I think that number is probably going to be pretty important when it comes to short-term market swings, not just for New York, but for the gold market and the resource stocks. So I think next Friday is you probably want to be paying attention to that number because if it's a bad number, gold's going through 1350, pretty much guaranteed. It'll probably do it that day. You'd probably see New York come off. You'd see the Dow come off, I would think, at least a couple hundred points minimum, if not more. If it's just, it might be a blah number. I'm kind of expecting one that isn't a big surprise either way. But there is potential for a negative surprise. I'm not convinced all of the problem has been weather the last 2 months. But that's what everyone's assuming. So next Friday's jobs report is probably one you don't want to miss. I put this up. I don't track ETFs a lot. I have this love-hate relationship with ETFs. I mean, I know a lot of people find them easy to trade and stuff, but as a guy that was brought up in the mining business, I've always been a little bit disquieted by the idea of everyone who wants to put money into the sector, putting money into the sector with ETFs, because the last time I checked, drillers and geologists like to get paid. And at the end of the day, somebody's got to write checks to the companies so that stuff happens. So while I certainly appreciate the ease, and maybe these ETFs have brought more people to the sector, I think you all want to remember that at the end of the day, for stuff to happen in this business, someone's got to be buying placements in the companies. We can't just all buy ETFs and have something happen. And that doesn't just go for mining, that goes for everything else too. But it's a good measure because it shows you interest on people outside of the usual suspects, if you will. And this is really what I wanted you to note, and I think it's actually quite important. If you look at where this is basically the junior miners, so it's the small producers by and large. This is basically a producers index, but it's the small ones. You know, this price level isn't one that gets me, you know, rip-roaring. I mean, I'd like to see it get past here at a minimum, but it's nice to see it's through the 200-day, but for me, the important thing is the volume. That's really, really impressive volume. That volume tells me that we are, in fact, seeing sector rotation. Sector rotation is a good thing because that's people deciding that a sector is too cheap. It's not just gold bugs. It's not just you know, guys that think the world's going to come to an end, so we better own some gold stocks. You see that kind of money come in, and that kind of a volume blip on this ETF. That's big dollars. That's basically funds that are, you know, part-timers in the sector have decided that it looks cheap and they're moving money into it. And at the end of the day, that's what's going to turn around a lot of these companies. Because I mean, we've all been here all along. We have to get the other suckers in to buy our stock later. That's how this market thing works. This is basically just running through what I put up at the start of the year for subscribers. I mean, 30% plus gain on the venture, which is not, you know, and I know that is not actually an impressive number. It sounds like an impressive number, but it's not really. All you need for that to happen is the small producers and the guys with resources, the guys that already have success. They have good years. The next tier down is an okay year, and you get several hundred companies that are basically going to do nothing. That will get you 30% because it's a market-weighted index. So if the 20 biggest companies in the index do well, they can really actually drag the whole thing. And that's how it's going to be. It's going to be top-down. I think we need more discoveries, but I think we're going to need, you know, several months of optimism at least before you really start seeing this helping the guys that are really in dire straits. So I'd be a little careful with some of the favorites you've got from yesteryear if they don't have any cash or anything. It's going to be a tough funding environment for a while for a lot of these guys. It's not, you know, it isn't a happy days are here again. I've had 3 guys on my list raise $110 million in the last month, but that's 3 of them. That's not the other ones. I mean, so you're still going to have to be selective for a while. Like I said, physical supply, demand, that's what I'm counting on for the gold price. And I haven't changed my $1,400 target yet, but I'm hoping to raise it, but I'm not going to raise it until we get there. You know, I do think there's a possibility of a PDAC curse, but I don't think it's going to be much of one this year because there wasn't that much of a run-up in terms of the news flow, so I don't think the news is going to back off very much. I'm not really bearish on the major markets. Like I said, I'm not a gold bug, apocalyptic, blah, blah, blah. But I do think they're so optimistic right now, that does make me a little bit nervous. It's just so optimistic that don't be surprised to see a 10 or 15% correction. And in fact, I'd be happier if I did see a 10 or 15% correction. Examples of the favored few: producers, low cost, high growth potential, and M&A potential, not just M&A potential as companies to take someone over, to be taken over, but also to take others over. 2 obvious ones that come to mind are Silvercrest and Nevsun. Developers that have resources that actually look viable, and I stress that phrase, that look viable. There's lots of guys out there with the resources right now, but be very cautious to stick with the top quartile ones. 2 good examples of that, Sunridge and Columbus. And also, I'm an exploration guy. I love exploration. So I'll always look for stocks with high leverage to positive exploration results and that are positioned to be able to deliver those results. 2 companies that fit that bill, Mondoro and Barisan. And amazingly enough, all 6 of these companies are here today. What are the odds, really? What the hell are the odds of that happening?